Well, hi everyone, Sean Humphreys here. Welcome to All Things Retirement. Well, in this installment, we're going to talk about a foundational principle for building or constructing your portfolio, not just for retirement, but also for the accumulation phase of building assets for your retirement years. So I think you'll find this content helpful. Now, if you're new to our channel, make sure you hit the subscribe button. We're posting content all the time on the accumulation phase, the transition to retirement, and being retired phase of retirement planning. So if you don't want to miss the content, subscribe. If you like the video, click like. Now, what is this principle? Well, before I get into the principle, let me just share with you what my experience has been over a few decades of working with families to get ready for retirement. And that experience is most people do not want to take on more financial risks than is necessary to achieve their goals. They may recognize they have to take on some level of risk, but they want to minimize that as much as possible. And what I'll also share with you is you get close to retirement, or if you're retired, fluctuating markets and economies that go up and down is not something that people really want to have to worry about. So they want to de-risk as much as possible. Now here's the problem. If you look at risk-free investments, and what are the examples? Well, it could be high-yield savings accounts, it could be guaranteed investment certificates or GICs, term deposits. The return that you get on those investments is pretty low. And historically, it's probably been 1% to 2% above inflation for a 5-year term deposit. Sometimes the returns are no better or worse than inflation. So if we look at the current environment we're in, you're seeing GIC rates of 1.5%, 1.75%, 2% as an example, while inflation is well over that. So the challenge with risk-free investments is that although they provide you with guaranteed capital preservation in the short term, you never have to look at your statement and worry about whether the investment you put into the GIC is down, right? You don't have to worry about market volatility. So you get your interest, and then when the investment matures, you'll get the money back, and you have to make investment decisions on savings accounts so you can get the money at any time. But the yields are very low. So for that guarantee, the yields are low, and what ends up happening is that most people, when they look at the retirement forecast, are losing ground pretty quickly. So if you have a 2% return on your GIC, and inflation's averaging 2 to 3, now you're losing money potentially, and then you might have to pay tax on that income at some point. So you're actually in negative return territory. So that's the first step. Now we call that the risk-free return. When I do a retirement planning analysis, I'll model for clients who are very risk adverse. Okay, what does this analysis look like? If inflation averages 2, and we're getting an investment that gives us 2, and we start drawing down on capital over time, what does this analysis look like? And for most people, they're going through the capital too quickly. The goose that lays the golden egg is just getting killed way too quickly. So we go back to the drawing board, and I say to them, okay, so the guaranteed rate is 2%. That's your natural default. How much more return do you need to achieve to aspire to your goals and objectives? If you look at this chart, the risk-free rate's 2, and you can see that we've got 3% for what's called the risk premium. In other words, the additional return that this client needed to get to achieve their goals. So their gross return was 5. They knew that they can get 2 in a risk-free investment, but they also know, based on the analysis that we've done for them, they have to get another 3% to achieve that 5% long-term return. Now that may sound pretty straightforward, but the reality is to get a 5% compounded return on average in this environment, clients need to be having risk assets in their portfolio. Stock ETFs, stock mutual funds, individual stocks, to drive up enough return to cope with the conservative part of their portfolios. So that's the starting point. What you want to do is take a look at the foundational piece, which is risk-free. What's the risk-free return? Then have your advisor or financial planner or retirement income planning specialist run the numbers for you. And by virtue of doing that analysis for you, you will be able to confirm how much more return you need to get above the risk-free rate so that you have a high probability of achieving your financial goals and objectives. So it's that extra 3% in my example that will influence the building of the portfolio. The foundation is 2. The client knows they can walk into the credit union or bank and get that on their own. They don't need the advisor or investment counselor to help them with that. But they know that they probably need help to get that extra 3 or 4%, whatever it is over time, to achieve their financial goals and objectives. Okay, so let's summarize. First thing is, what does your plan look like using the risk-free return? If you're going through your capital too quickly, how much additional return above risk-free do you need? Quantify that. Once you know that number, then your advisor will be in a position, or you'll be in a position, to begin designing a portfolio that has a probability of hitting that additional 3% that you need over time in this particular example. And now you're getting into the mix of stocks or bonds or guaranteed investments in the portfolio to drive that return over time. Okay, so that's a foundational principle. You need to start there before you even start talking about the specific investments that you'll place in the portfolio. You need to know your numbers, risk-free, and then the premium return, the risk premium return above risk-free. What is that number for you? Well, it's my hope that you found this video helpful. Now, if you're looking for additional resources on retirement income planning, make sure you hit the link in the show notes to our website. It'll take you to information on how you can get your own customized retirement income plan so you have clarity and peace of mind about your own retirement. If you scroll down to near the bottom of that page, you can also get a hold of some free resources. Maybe you're more just in the information gathering stage of your retirement planning journey. So those free resources, we can get videos, PDF documents, planning tools, so you can get up to speed on the key issues around retirement income planning. Anyway, wishing you all the best in your retirement planning. If you haven't subscribed, make sure you do that so you don't miss future content. And if you like the video, make sure you click like. You take care.